Back with us here on Trading Hour. The Nifty continues to remain choppy on the day of its monthly expiry. Good time to get in Madanagopal Ramu from Sundaram Alternate Assets, who's now joining in. Madanagopal, good morning. Thank you for joining in. I just read your note where you mentioned that you continue to have a fairly higher exposure to the mid and small caps in comparison to a fairly street consensus of moving towards the large caps because they are the ones that now offer more value compared to the broader markets. If you could explain why is that so, and if the broader markets are set to do well, what happens to the large cap trade?
Right. Large caps, we feel the problem is on the earnings side. While the valuation, you can still argue that there are certain sectors because the earnings has been subdued, the valuations also been moderate. But it's not that large caps are not costly. For the kind of almost like Q4, we saw the earnings growth of large caps were in single digit, even adjusted for financials. So we feel that large caps lack earnings growth. Even if you take a 2 to 3 year view, there are many sectors in large cap like banks and IT sector, FMCG, and even oil and gas. Together, they form almost like 60-70% of the Nifty. The earnings growth may not be in double digit. It will be in higher single digit. So we feel that if you want to make money in market, you can't be exposed to these traditional sectors. You have to move beyond the large caps. You are right. Mid caps valuations are looking higher, but it's looking higher because of the earnings growth in specific pockets being much better. And we feel comfortable in playing some of these segments, and even in Q4, segments like capital goods, NBFCs, even some of the spaces in healthcare have delivered quite a good earnings beat. So we feel that it's better to approach the market not as a capco basis, which is more traditional way of approaching the market. It's better to approach stock specific and sector specific and theme specific. And and there are segments within the market, even across the capcos, which are offering high double-digit sort of earnings growth. Even last year, when the overall Nifty's earnings growth was in single digit. So that's the reason that we remained with the mid and small cap during the correction, and we also added we made some sector rotations, but fairly remained more towards the mid and small cap space.
Okay, you've remained more towards the mid and small cap space. You've said that you've made some sector rotations as well. And right now also sector stocks is what one should look at more than just looking at large cap traditional side of investing. What sectors are you looking at then?
The capital goods, particularly the power equipment side of the capital goods, have given a major beat to the earnings, and also from the commentary point of view, given what is happening in India as well as globally. Power equipment side looks pretty good. Across the transmission, generation, and distribution side, there is a lot of capex happening. If you look at recent grid stability issues that came in Europe, there is a lot more talk about the renewables mix in the grid, creating more opportunity for more transmission capex. If you see some of these, the equipment manufacturers, there are only 3 companies globally, excluding some of the Chinese players, who are capable of doing these transmission equipments. Even in India, if you see the HVDC projects, you see bidding only coming from Hitachi, GE, and Siemens. It clearly plays where competition is lower, opportunity is going up. At least for next 2-3 years, we see visibility of capex happening across transmission and generation, and competition is limited in India as well as global as well. In India, particularly last decade, we saw Chinese competition being higher, which has come off now. And India is very clear on supporting the domestic manufacturing. So that is, if you see the margins of these companies, which were in single digit in the last decade, it has moved into almost a higher double digit, sort of higher teen sort of margins. In addition to it, you are seeing the order book almost growing 30-40% across these companies. So we feel that capital goods in power sector looks pretty interesting. At least next 2-3 years, the visibility is good. We also feel NBFCs, which has been always our structural call, and we feel that compared to banks, NBFCs are better positioned. But I'm very specific to the companies we are referring here. And growth has been pretty meaningful. Healthcare also looks pretty good. The rotation that we did was we booked some profits in e-commerce space, where we saw the earnings growth is getting cut right now, and we shifted them back to some of the capital goods names and financial space.
Okay. Madan, you highlighted a couple of points. One, in terms of power. Power is what you're talking about. You're expecting them to do well going forward. But do you expect across the board, so transmission, generation, as well as distribution, and which companies are you looking at? Because you're looking company specific also. So which companies in India are a better bet right now?
Obviously, I even mentioned these names. GE, Hitachi are listed names and pure play on transmission capex in India, and also they are getting opportunity to export right now. So we feel these companies. There has been a bit of a rally in these names, so investors can look for some sort of a correction to get in. But if you take a 3-year view, I think still they have quite a bit of growth left in them to support decent returns from these spaces. We would rather play capital goods, the entire power story in the early cycle, rather than playing the utilities. So that's the reason to highlight on the capital goods space within the power sector. We also like, with the recent correction that has happened in the cable space, like KA, Polycab, the valuations become reasonable, and the companies are looking at 20% sort of a growth. If you look at even the large cap, if you exclude the traditional sectors which generally trade low in terms of multiple, even growth part of the Nifty is trading at 25 times. So if you're getting, and growth part of the Nifty is around 15% sort of a number. But if you're getting mid-cap names at 20% plus sort of a growth with 25 times sort of a 1-year forward multiple, make a decent entry point for the investors with a 2 to 3 year view.
What about the oil marketing companies, Madan? Because there is a fair amount of chatter with regards to them in the oil and gas space. And when you mention oil and gas, these are the names that first come up, the HPBPs and the IOCs. Where, in terms of where are you positioned here? Would you prefer the OMCs in comparison to the ONGCs or the Oil Indias, or your preference is otherwise? Because in both cases, the dividend yield factor also comes into play as well.
No, actually, I mentioned that these are part of the Nifty which we are avoiding at this point, primarily because the earnings growth has not been pretty impressive. And we don't think, given the global noise around the slowdown, oil prices are not likely, oil demand particularly not likely to surprise you on the positive front. So we would stay away from it, and it's very difficult to track the global commodities, in our opinion. There could be some tactical opportunities sometime, but we have felt that taking a high conviction bet on these are very, very risky. So we have mostly avoided the oil companies in our portfolios.
You're avoiding these oil companies in your portfolios. Madan, quick question, right? You said you do like healthcare space as well. Is it only healthcare or even some of these pharma companies? Because you have a lot of commentary that keeps coming in on tariff front. Today also we did have some updates coming in. So is there something like, you would look at global pharma companies, CDMOs? What are you looking at there?
Within healthcare space, we have hospitals, and that's a very specific call on one of the hospital names, which is going through a merger now with and thereby becoming third largest hospital group in India. Creating a good bit of value if you come in and stay invested for 3 years as this merger happens, and then the synergy benefits plays through, and the valuation also gets a chance to get re-rated here. On the other side of the pharma space, we like CDMO companies. CDMO companies, we are seeing quite a bit of activity and healthy pipeline for the Indian CDMO companies from global, and this is irrespective of whether tariff happens or not in favor of India. China plus one story has been pretty much happening in the CDMO space. So we are interested in CDMO space and hospitals. Generic pharma, no. We actually had Cipla, which we exited recently because the earnings growth trajectory is pretty subdued in the generic pharma space. Even in the domestic pharma space, growth is decent, but will you really pay 30-40 times multiple for a 10% growth? That's a question that we are finding it difficult to justify.
Okay. Madan, last quick one. You spoke about NBFCs and you said particular names in NBFCs, and you've also had a tactical bet on MFI space. So what is the name over there? What should one look at right now?
I think in the previous episodes also we have discussed about some of the regional NBFCs becoming bigger over a 10-year period, like what happened with Sundaram Finance itself, our parent, how they've grown from a Tamil Nadu-oriented sort of business now to pan-India, and growing from, starting from vehicle finance, now moving into housing loans. So this is a very well-established model of growth and very successful model. And given what you have seen with Sundaram Finance creating wealth for the investors in the last 15 years, since the time I've joined Sundaram also, it's phenomenal. And you can't take eyes away of it, but you have to select the right names here. So when we look at it, Chola has done it well. Bajaj Finance, no need to mention about it. And of the other emerging names, we find Five-Star, Home First, sort of companies having similar attributes. They are looking at a long-term growth. They are building right kind of franchising, and they are starting from 2-3 states now and then becoming larger in other states, at least 10 to 12 states in India, where you can build a similar size of what you have built in the homegrown states. So this is a well-established, very clear structural model, and getting them early is very helpful. And that's the reason to stay with some of these NBFCs. Despite last year has not been great for NBFCs, recently they have pulled back pretty nicely with the noise around the unsecured loans coming down.
Sure.
On the MFI space, yes, it was a tactical bet, and we have gone into credit access recently. We hear that the NPA issues are getting resolved. It's not happening as quick as what you'd like to be, but I think first quarter to second quarter next year, most of it should be behind you. And valuations are reasonable in the space, and lack of competition and lack of capital will create value in MFI space for good players.
Okay. Okay, Madan, thank you so much for joining in with us on the show and giving us insights in terms of markets as well as sector-specific view. But on that note, we're going to step into a very short break, and on the other side, we'll put the spotlight on stocks like Deepak Nitrite, Welspun Corp that are buzzing in trade. So don't go anywhere.